Okay, so we do have the privilege of having Grant Cullens with us this morning. Grant's from Global Value Investors, and that's one of the fund managers that we use for international shares. Join me in welcoming him this morning. Thanks, Grant.
Well, good morning, everyone, and thank you very much for taking the time to come and listen to what I have to say here in what is a fantastic location, I have to say. As Craig has just said, I am going to basically give you an overview of our view of the world at the moment and how we see things panning out over the next few months. We'll cover a number of different topics. One of the oldest axioms in the stock market, and in fact I've never seen as much coverage of it as I have this year. Of course, it's sell in May and come back on St Leger's Day. St Leger's Day is actually in mid-September. It's a horse racing event in Yorkshire, godforsaken place in the UK. I can say that fairly confident that there aren't an awful lot of people here from Yorkshire. But in fact, there is some merit to that axiom which has been used in the markets, and we'll touch on that in a second. We'll then look at the actual state of the economies on a global basis at the moment, because there's been obviously a lot of economic data out over the last couple of months, but in fact just overnight, driving up here this morning, there was more data which I heard, which to some degree does raise some serious questions about the longevity of the recovery that we have in fact seen. I'll then look at something which is particularly topical to all of us. It's the inflationary impact that the US and indeed some of the other governments around the world have brought on us by pumping liquidity into the markets, and we'll look at the longevity and the impact of that. And of course, the oil shock, which to some degree is starting to dissipate now, but nevertheless is still still has a meaningful impact on all of us. And then, of course, the implications for equity markets. A quick look at the Stock Traders Almanac does show that there is, in fact, quite a lot of seasonality in stock markets, as I'm sure some of you just intuitively know. The fact is that May, February, and September are, in fact, some of the best months to invest in. If one looks back in time, you can see from there that the best results in terms of performance do in fact come from the sort of October through to April periods, and then the summer periods, surprisingly, or perhaps not so surprisingly, don't see such strong performances from the equity markets. Now there's actually a number of reasons as to why that is, and they are more, I suppose, a function of sporting events that you get going on in the Northern Hemisphere. In the UK in particular, you have things like Wimbledon, you have the summer holidays, and of course you have the big horse racing calendars events. And the fact is, in the older days, people used to literally leave the stock markets, move out of the city, and of course activity used to actually drop down. I mean, it was as simple as that. There is nothing more sinister to it than that. Over the years, to some degree, that effect has been reduced, but the reality is that the summer holidays are a big detraction from people getting involved in the markets. There is a word of warning though. In the last couple of years, I think it's fair to say that these are particularly unusual circumstances which have definitely distorted that normal seasonal pattern. As you're aware, we've had massive intervention by the US federal government and indeed other developed country governments in Europe in particular, going some way to actually bolster what has been going on in the economies. And to some degree, this has actually distorted what's been going on. Indeed, in 2009, we had a particularly strong equity market over the summer period. If one looks at other asset classes, fixed income, commodities, there has in fact been some fairly strong movements in those as well over the last couple of years, and you'll all be familiar, I'm sure, with the comments that have come out in relation to some of the commodity markets. Oil, gold, silver, all have been particularly strong. So I think this time, this year, our suspicion is it's probably going to be more of a sell than the last 2 years. That is something which remains to be seen for the moment, but that risk is certainly there. So if we look at the broader economy and the global economy, certainly in the developed worlds, is it really all that bad? I know there is a perception out there, certainly at the retail end of the market, that we haven't really recovered from the GFC. I've got a couple of charts here, and I could have chosen any number of charts, to be honest, to reflect just how strong the economic recovery has been, both in the US and in Europe. This is the US, corporate profits. I mean, it's a little bit difficult to see here, but the chart does illustrate just how strong that recovery has been from the lows in 2007, 2008. There are a couple of reasons for that. The first is that when we went into the recession, companies cut very, very aggressively into their workforces. And as you know, unemployment rose very, very sharply. The net effect was that when the recovery started to come through, essentially what they call the operational gearing in terms of the speed at which the profitability recovered was very sharp indeed. And this chart on the left looks at the corporate profits, and you can see it was virtually a V-shaped recovery in terms of profitability. One of the other things which manifested itself from that, of course, is the amount of cash that companies have had on their balance sheet. And this doesn't just apply to companies in the US, but in fact it's Europe and indeed in Australia as well. As a result of this recovery and not taking on more employees, the amount of cash which companies have on their balance sheets is now at record highs. And we've seen various politicians now start to sort of stick their oar in and basically say that they want a slice of that. And Obama just a couple of weeks ago, and indeed in the UK, George Osborne, who's the UK Treasury Secretary, basically said that their job now is to get out and encourage companies to actually start spending that money. Funny that. So the reality is you've had a very sharp recovery, and that has been reflected in the share price performances over the last 2 years, with the S&P, for example, up nearly 95% from those lows. The economic data that's been coming out, and we look particularly closely at what are called the leading indicators, have been expansionary. Now, there was some data out last night in the US, ISM data, which did suggest that things are starting to slow down. And this is a fairly typical trend that one would expect as a recovery starts to mature. As I said, we've had 2 years of this recovery so far. So all we're now getting is a slowdown from those high points. And there's nothing particularly unusual in that. But clearly the commentators, the press, and everyone else, they love to have a field day with this sort of data. And there are a lot of suggestions now starting to knock around that, of course, we're going into another recession. Our view is that that is not the case. Provided the leading indicators remain above 50, which is basically shows that an economy is still expanding, then all that you get is a cyclical rotation of sector performances within the stock market. It does not actually mean that the stock market is necessarily going to fall. Now, during that period, as they start to roll over, that inflection period, clearly there is a lot of uncertainty, because you have on the one hand some people saying, well, the stock market's going to fall over, the economy is going to go into recession, and then you have the other people on the other side saying, no, this is just a cyclical slowdown as growth just moderates. And you get this great uncertainty, and I think that is the phase that we're probably going through at the moment, and getting some fairly large swings in terms of stock market movements on a daily basis. This slide was taken from Credit Suisse, and it quite neatly illustrates just how things like the new orders are being monitored across the various countries in the world. The data on the right was put together obviously in March, and you can see that there's a lot of red there. That's actually a positive, not a negative. What it's saying is that economic growth is still pretty robust in those regions. The map on the right-hand side there just shows that it's starting to moderate in various areas. And you can see in China in particular that there is evidence of that slowing down. And that is certainly one of the key concerns that people do have. And it has massive implications potentially for Australia. But we'll come on to that a little bit later on. The other interesting thing there is that the US actually is still deep red, which is positive. It's showing that the economy is still expanding, albeit at a much slower rate. The fact is, though, that in the US in particular, it is going to be a long haul. I'm sure you're all aware that the housing market in America is in a pretty severe recession. They've had about 5 years of that. Typically, they last between 5 and 7 years. Cyclical downturns in housing markets. It's pretty much the same in the UK. One of the worrying things is that the new house sales data in America has started to roll over again downwards. It's estimated that there are something like 500,000 new empty homes in America that haven't been lived in at all. And there have been suggestions by some in Congress that they should send in the army and basically bulldoze the houses and just start from scratch. The main issue, of course, is that many of these houses have been built simply in the wrong place. During the periods of recovery up to 2007, a lot of companies thought that they would build more plants, expand their businesses, and so they went out into greenfield sites, and the builders and developers basically followed them. 2007 came, and of course it all turned upside down very, very quickly. And so it's one thing saying, well, there's 500,000 spare houses out there, and we can get them very, very cheaply, but you know, who really wants to live in the middle of the desert? So that is a very real problem that they have. There is some anecdotal evidence I've heard stories that companies in China are now busing Chinese tourists around parts of Florida and California, basically looking to buy property, residential property. And interestingly, I live just outside St Ives in Warrawee. I nearly forgot where I lived then, in Warrawee. And a couple of weeks ago I was driving down Mona Vale Road going out to the coast, and just got up to what's called St Ives Showground, and there's a lay-by there, and there was one of these big American silver caravans with all the US bunting flags outside and everything. And as we drove past, I thought, that's a bit odd. But then I noticed that they were actually advertising US residential property, which I thought was quite telling. So there are certainly moves afoot for people in the US to try and retail or to sell property over here. And given the strength of the Australian dollar, that's probably no great surprise. So there are a lot of efforts going on to try and encourage overseas investment in the US market, but quite what traction that will get, I'm not really sure.